Hey Bowtie Nation, Joseph Hogue here with the most underrated investment in the market, the index fund. The best index funds are like watching paint dry, so boring that you look for other things to do and just enjoy life, while the funds add extra zeros to your bank account. The worst index funds, though, can be like gravity. You forget it's there until you're dropping 1,200 feet at 180 miles an hour with your sphincter up somewhere between your ears. I found 5 index funds that will never let you down. 5 exchange-traded funds that are going to give you that whole market or the big slice of it, and those set it and forget it returns. I'll highlight the top index funds for different investments, then the very best to buy above all the others. And let's start with one that has gotten a lot of attention lately, the Vanguard Developed Markets Index Fund, ticker VEA. The fund invests in a diversified mix of small, mid, and large cap companies across the developed world, including Canada, Europe, and the Pacific. There's more than 4,100 companies here with some of the most recognizable brands, including Nestle, Samsung, and Toyota. The fund pays a 3% dividend yield, well above you get with the S&P 500, and provides that exposure to international stocks in an easy, all-in-one package. Most investors, especially U.S. investors, are absurdly overexposed to their own market and have little or no stocks of foreign companies. It's something you don't notice when times are good, but when the economy drops off a cliff, as it has with the U.S. this year, that investment in foreign companies denominated in foreign currencies goes a long way to saving your ass. And I know some of you are saying, well, why not just buy the Vanguard Total World Stock ETF, the VT, which holds almost 10,000 stocks around the world, including emerging markets and international, but there's 2 reasons I like the VEA better here than that VT. First, because that 64% of stocks in the VT are from the US market. It's basically a US index fund masquerading as a world fund. But also that marginal investment in emerging market stocks isn't all it's cracked up to be. Nation, as someone who started his career analyzing emerging market stocks and living in one of those emerging markets for more than a decade, these stocks are perpetually emerging and rarely produce the kind of return they should. Basically, emerging market stocks are that cousin always talking about his next big business idea. Theoretically, he should eventually get a successful one, but you know he's always going to be living in his mom's basement. With the VEA, you get that needed diversification into strong, developed markets, but without the basket case that is emerging market stocks. International stocks have lagged their US counterparts in the bull market, and the fund has only returned an annualized 6% over the last 15 years. This is one you'll wish you had more of when the U.S. market crashes. So far this year, with U.S. stocks in the S&P 500 down 10%, the VEA is up more than 6%. So owning these international stocks would have saved a big portion of your portfolio. Now, what we'll see in a lot of these funds is, even as an index fund, there are still important investments missing. Now, from the VEA fund, you've got those U.S. stocks to other assets, so it's always best to pair a couple of index funds together to get that truly whole market returns. By the way here, if you ever want to see exactly what stocks are in an ETF, you can always go to its website and look for either portfolio or holdings in the menu. It's going to show you the sectors as well as the individual stocks. It's a great way to get ideas for stocks to buy if you want those investments in a specific theme. But if you want to see the stocks in my portfolio, check out the invite link to the Blossom app I'll leave in the description below. Blossom is the social media app we've been waiting for, made by investors and for investors. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and the average dividend yield across the entire group. You'll also be able to join more than 200,000 investors in the social feed to see what everyone else is talking about. Click through the link to see my portfolio and get ideas for your own. The next index fund on our list isn't like the others. The iShares Expanded Tech Sector ETF, the IGM, is narrower than a broad index fund idea that we're talking about with these other stocks, but I wanted to include it here because I feel like a lot of investors are holding that NASDAQ 100 QQQ index when they really should own the IGM instead. That NASDAQ 100, the QQQ index, holds shares of the 100 largest non-financial companies listed on the NASDAQ exchange. And we generally think of this as the tech index because it's loaded with all those tech heavyweights like Apple, Microsoft, and Nvidia. More than 60% of the stocks in this are tech and communication services, but if you look closer, you also see some decidedly non-tech stocks like Costco and Pepsi. Slower growth stocks holding back the returns in nearly a third of the fund outside of tech. That means the $323 billion of investor money held in that QQQ index fund may not be the best fund for what those investors want from it. If you're looking for that tech focus and the growth, the Expanded Tech ETF, the IGM, is all tech all the time. The IGM holds shares of 278 large companies in hardware, software, internet, all the things driving growth and the markets. And you see the difference here in returns. Both the QQQ and the IGM are very tech focused and follow each other almost perfectly. But those non-growth companies hold the NASDAQ back, with the IGM beating it by just over 10% over that 5-year period. And while tech and growth stocks have taken a giant crap on investor portfolios, with the sector down 10% this year, tech is where the returns are, up 138% over the last 5 years, easily outpacing the rest of the market. So here, even though the IGM isn't strictly an index fund like the others on this list, every investor needs some exposure here, a focus that is going to help boost your returns a little beyond the broader index funds. Another one of the best uses for index funds is for those asset classes outside of stocks that you might not own, and here's one of my favorites, the Vanguard Real Estate ETF, the VNQ, with its 3.6% dividend yield. The VNQ holds shares of 158 real estate investment trusts in the United States, giving you instant exposure across every property type and across the country. This is the commercial real estate market. The 5-year return hasn't been great for real estate here, posting a gain of just 12%, and most of that within the past year. Higher interest rates crushed the investment over the period, but just as property boomed higher after that 2008 crash, these are going to do well over the next few years. Until that rate-driven sell-off, shares of the VNQ had produced a 10% annual return over more than 2 decades. Besides that return, this one is going to give you that diversification for a stock portfolio, along with the inflation-fighting power of real estate, and an index fund in the easiest possible way. We've still got 2 more must-own index funds, but I feel like there's a big misconception out there between index funds and ETFs, or exchange-traded funds. It's a gray area of investing that is actually a lot more important than you might think. You see, an index fund is a passive group of investments bundled together, and then shares of the entire group are sold to investors. Buying a share of the fund means you get the returns on everything in the group instead of having to buy hundreds or even thousands of stocks separately. And for this, you pay a small percentage fee to the manager. Now, this might sound a lot like an exchange-traded fund, an ETF, and it's because index funds are sold as ETFs or mutual funds. You buy them just like stocks, and you can buy many with no commissions. But where the confusion sets in is not all ETFs are index funds. You see, index funds invest in that broad benchmark group like the S&P 500 or the NASDAQ, or across an entire asset class like real estate, stocks, or bonds. The manager just replicates the index, all the available investments, so they're investing passively and have no control about what goes into the fund. That's different from a lot of theme ETFs, like for example the Vanguard High Dividend Yield Fund, the ticker VYM, which I like but is not a true index fund. The VYM, like other non-index funds, bases its investments off a strategy or a theme, in this case companies that pay above average dividend yields. So by comparison, the S&P 500 is a broad stock market index. The NASDAQ 100 is a broad index of the 100 largest non-financial companies listed on the exchange, so more broadly defined and inclusive of all stocks in that group. And I know by now half of you are just screaming, get on with it already, but the difference is hugely important and why every investor needs an index fund in their portfolio. Buying an index fund means you get that broad market exposure. You are the market, and you're always going to get that diversification and the return that you can only get from the entire market. On the other hand, ETFs focused on dividends or growth are also critical to a portfolio, but investors don't realize what they're missing when they buy only these hot ETFs and not a true index fund. So let's look at that Vanguard Dividend Fund, the VYM, versus a true index fund, the Spider S&P 500 Trust, the SPY. Now the VYM holds almost 500 stocks, so you'd think the risk is spread out really well here, but if you look at the weight of each sector in the fund, the picture starts to change a little. The stocks in just 4 sectors, consumer staples, energy, financials, and healthcare, make up more than 57% of the fund. Just 4 of the 11 sectors of the economy are more than half of the fund. And so here, when you compare the stocks in the VYM with those in the S&P 500, what most people use as the benchmark for the stock market, it is a completely different picture. For example, more than 27% of the S&P 500 is in tech stocks, while the group makes up only 6.9% of the VYM ETF. Energy stocks make up 10% of the dividend fund, more than twice the exposure in the overall market. And I know it seems like a big nothing burger of a difference, but it will be critical to your portfolio having at least 1 or 2 index funds in your portfolio. And I know because I've been there. Getting started investing in 1999 while still in the Marines, I was investing to get rich. Living on $1,300 a month is no fun, so I was all in on those internet stocks and lost my ass when the dot-com crash wiped out the market. Come 2008 though, with 7 years investing and starting my career as an analyst, I made sure I had a mix of index funds, ETFs, and asset classes. I still saw a lot of my stocks fall, but not nearly as much as the rest of the market, and I was able to take advantage of the crash to buy in cheap. Easily the most underrated investment among the underrated index funds, bonds in the Vanguard Total Bond Market Index Fund, ticker BND. And before I get all kinds of hate comments about bonds being shit for years, the rally last year has meant that bonds are on the way back up, and it's been an even bigger protection than real estate this year, with the bond fund beating the stocks in the S&P 500 and the NASDAQ by more than 10% year to date. The fund invests across quality U.S. dollar-denominated bonds, including government, domestic, and even international exposure, with more than 10,000 bonds in the portfolio. It pays a solid 3.6% dividend yield and gives you exposure to the entire asset class for a little safety outside of stocks. And I know here, just saying that you need to invest in bonds isn't enough, but think about it this way. Investing solely in stocks is like eating nothing but steak. It tastes great and it's going to fill you up, but it's going to give you that heart attack the next time the market nosedives. Bonds are the veggies that help keep you healthy in any market. Now, we've still got the single best index fund to buy, but while these funds are great on that whole market return, there's another way to get that low-risk, set-it-and-forget-it investment with even higher returns. Check out this video in the corner for my favorite ETFs to buy for 2025. That same low-risk strategy, but with more focused on specific themes for higher returns. And my favorite index fund for growth and the overall market returns is the Invesco S&P 500 Equal Weight ETF, the RSP. Now, the RSP isn't an all-inclusive index fund like the Vanguard Total World ETF, but it does give you exposure to the vast majority of what you'll find in that world fund. In fact, the S&P 500 index, the 500 largest companies in the US, and what we usually mean when we talk about the stock market, is more than half the entire global stock market value. US stocks account for 59% of the world's stock market valuation, with almost all of it just in the 500 largest. And that means a simple pairing of, say, the RSP with a developed market fund like the VEA gives you 80% of the world's stocks. But there is also another reason why I like this RSP instead of weighting each stock by company size like we see in the S&P 500 benchmark. The RSP holds an equal amount in each stock in the index, spreading the exposure out evenly across it, so you keep that index exposure to the largest US companies, but across all of them. Well, weighting also clears up a sector-level problem in the S&P 500, dropping tech stocks from 27% of the group to just 13%, and communication services from 9% to just under 4%. While other stocks get a little more exposure. The fund is going to tilt your exposure towards smaller companies since they have that higher weight than in the regular S&P 500 index, but even the smallest company here, SanDisk Corporation, is still a $6 billion giant, so this is still very much a large cap fund. Even better though, because of those big tech companies that are overweighted in the traditional S&P 500 index are lousy for dividends, the RSP ETF pays a higher yield, a 1.5% versus the 1.2% average in the market index. It's just a great way to keep that index fund safety and get the market returns, but without putting your portfolio at risk in just a handful of tech stocks. Join me on the Blossom Investing app and see what over 200,000 investors are talking about with a special invite link below, or click on the video to the right for the best ETFs to buy in 2025 in every theme. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.